Hey, welcome back. And we're here again with our good friend, Matt Brown, lender extraordinaire. Is that right? Okay.
That sounds good. I'll go with that.
Okay,
Yeah,
there
thank
you
you.
go. And we're here, and what we want to do is a set of videos to where we're going to kind of go over different types of loans, and we want to very much invite, if you got questions, definitely put them in the comments, because that's the big thing that we really want to be able to do, is to answer any questions that folks have. So today we're going over FHA loans. We're just going to start there.
Love FHA loans.
Yeah.
Been doing them 25 years.
A long time.
Yeah.
So I think a lot of folks hear about different loans. Obviously, FHA being one, VA and conventional are the main kind of ones everybody hears. Tell me, what is the basis for kind of an FHA loan? You know, in other words, what's the concept behind it?
Yep.
And maybe even, we're going to go over a number of kind of questions that we had, but, why you like doing them so much? I mean, what's the concept there?
FHA came about in the late 1930s, and it was designed to help people get into homes for less money.
Okay.
I remember when my parents were buying homes, it was 20% down. And now it's hard to put 20% down.
Yeah, it is.
So FHA, it's a government-backed mortgage.
Okay.
It's just more lenient. They're more flexible to credit. They're more flexible to down payment. Reserves in the bank.
Yeah.
They're just a more lenient. So a lot of first-time home buyers use FHA loans.
Okay, yeah.
Yep.
And I think the 20% thing, we get that a lot FHA from our side, of people thinking you have to have 20% down when you don't.
Right.
It's normally 3.5%.
That's
and-
FHA,
yeah.
3.5%. Like you were saying, conventional FHA, VA. I mean, that's 90% of the business right there. Just that.
Yep.
And so I would say with my workload, it's conventionals probably 70 and then 30% FHA.
Okay.
So that's about what it breaks down to. But FHA is a great loan, and it's 3.5% down. The only negative that people think about FHA is that FHA has mortgage insurance for the life of the loan, unless you can put 10% down.
And it didn't used to be that way.
Didn't used
when
to be
did
that
that
way.
change-ish? Do you remember?
Probably
like
five or.
Yeah,
I was going to say
4 or
5 or
5.
6 years ago, somewhere around there.
Yeah.
And now on a conventional loan, when you have 20% equity,
then you
PMI
can
drops
get it
off,
removed.
or 20% equity getting in, you don't have PMI.
Yeah.
But FHA has PMI for the life of the loan, mortgage insurance. Unless you can put 10% down, then you have it for the first 11 years. But I tell people all the time, if FHA is the better loan type for you,
Sure.
let's do FHA. And then, when you start getting more
always
equity,
refi,
you can always refi. Your credit starts getting a little better, then we refinance into a conventional and drop PMI off at that time if we've got 20% equity.
And I think the biggest key that we always talk about is people get too hooked into all the details of an initial loan without realizing, again, you're not stuck with it forever.
Correct.
So right now, rates are higher than they have been, and we're hoping that they're going to come down. We need to continue to throw out there, if folks are waiting for 3%, you need to forget that.
It's not going to happen.
Yeah.
And we don't want that to happen. Nobody made money at 3%.
Yeah.
And our country was in some really deep problems.
Yeah, and it was to bail out a lot of
Correct.
problem stuff that happened back when, a lot of foreclosure stuff happened. It was to try to get folks back in there. But I think the bigger key is folks waiting to buy a home because of the interest rate. And I think the big key becomes when the interest rate, and it will, when the interest rate does make a, I would say kind of a significant drop, and I'm saying into the 5s.
Right.
Probably
I think
high
so.
or maybe even low 5s, but
right before we went into Iran, I mean, we were locking conventional loans at 5.99 for several weeks.
Right
there,
under 6.
I mean, I'm telling you, that phone was blowing up, and we knew that it would.
Well, and I was going to say the bigger key is the minute that happens, your home prices are going to go up because more people are going to now go, I'm ready to buy now, and it's like anything. It's like bring out the newest, greatest, whatever that is, electronic thing or something, and all of a sudden everybody shows up.
Right.
It works the same way with real estate. All of a sudden, when interest rates do get to that lower amount, guess what? Now you're fighting the pricing battle, and the pricing battle is worse than the interest rate
battle. And we talk about that all the time. I mean, if you want to win, now's the time to win.
Sure.
We're in a buyer's market.
Yeah. You have options.
You have options. Get in at this is the lowest price this house is going to be for the next 5 years potentially. Get the price, get in, and then if the rates come down, which they're going to come down, they're projected to come down, then when they do, we just refinance. But if you're sitting on the sidelines waiting, like everybody else, and when that rate drops a half a point and everybody jumps in, which they will, because they were doing it in February and March, it's hard to win in that environment.
Yeah, and right now,
it really is.
And I don't want to get too far off the subject, but right now, Vicki and I have done a bunch of options, or a bunch of videos talking about, as a buyer, you have some options. You have some options to negotiate. You have some options to maybe get some
seller concessions.
Buy down, seller concession, things like that.
Yes.
Whereas, when we were in the 2020 and 2020 range,
you're waiving appraisals.
You did crazy things where it was almost like, no options, or just crazy things that were in you as a buyer's best interest.
Correct.
And that's the thing that we're trying to get through to folks.
Correct.
So kind of back to what we were talking about in terms of, FHA loans and stuff like that. So is there a person that the FHA loan is necessarily better or tailored to?
There is. I mean, and because I've been doing it for so long, I'm in my 25th year, I literally can, like most loan officers that do a lot of business or do business, you can look at a file and within 10 or 20 seconds is that an FHA profile or a conventional profile?
Yeah.
It's like a mechanic that can hear something wrong with a car.
Yeah.
Same thing with us. And so basically, an FHA loan is more conducive to people that have lower credit scores and lower monies to work with, and not a lot of money's in the bank. On an FHA loan, you could be dead broke on the day of closing.
Yeah.
Whereas conventional, you need to have 2 or 3 months reserves.
Yeah.
And on an FHA loan, 100% of the down payment and closing costs can all come from a gift.
Yeah.
That's nice.
And the thing to remember is, I know sometimes folks can get a little bit embarrassed with credit scores and things like that. And I think the thing that's more important to realize is not to worry as much about that. Look at what the opportunity is to get out of, say, leasing where you get zero. I mean, going back to that interest rate thing, we've always joked about, folks go, gosh, I'm not going to buy a home because it's 6.7% interest or whatever. And it's like, but you're leasing a home or leasing an apartment, that's 100% interest.
Right.
And
what's better?
It's better to say, don't worry about those things. Everybody has gone through tough times or different things like that, to where not everybody has the high 7s or low 8 scores or whatever. And it's a great thing to push towards, but it's not the most important piece of, you're better off to get into a home and actually be able to get some equity, something that's starting to help you, not the landlord.
Talking about credit scoring, conventional loans, they do what's called risk-based pricing, RISK. So 740 and greater, they're going to get the best interest rate out there, the lowest interest rate out there. And you've got what's called LPA, loan price adjustments. So basically, when you've got a 720 to 739 on a conventional loan, you take a hit. 700 to 719, you take another adjustment. 680 to 699, take another adjustment. 660 to 670. So the further you get down on the scale, the higher the interest rate. Whereas FHA doesn't price that way. If you've got a 660, you're going to qualify for the lowest interest rate on FHA, versus if you had a 660 on a conventional loan, you've taken 4 or 5 adjustments. And so conventional loans, on average, are about 1/4% higher than FHA and VA. Those government loans are just about 1/4% better. So that's why you can get a better interest rate at a lower credit score is going conventional. Now, the only other thing with FHA, they have what's called an upfront mortgage insurance premium. So it's 1.75% of the loan amount, gets rolled into the loan amount, doesn't impact your closing cost. But that's the only other knock, is that upfront. And the reason why they do so, because they can keep the monthly mortgage insurance premium 0.55. Or, so that's typically what it is on 3.5% down, 0.55. Whereas if you've got a lower credit score on a conventional, that monthly could be 0.8, 0.9, 1 point something. So that monthly mortgage insurance is going to be higher, which obviously increases your payment. So that's, FHA has some really great advantages. They do.
So again, first-time home buyers, stuff like that, and maybe less than perfect credit type folks, things like that seem to be a good fit for them. And it doesn't have to be them. Again, the key is getting with Matt and his team and saying, here's what we have, send me the right direction. As to what's the best thing. And that's what's nice, is he has so many different avenues to try to work with folks to try to say, okay, look, we're putting you in the best fit for what's going on.
So FHA, you can go down to, our company goes down to a 580 at 3.5% down. FHA doesn't have a credit score requirement. They don't. I mean, you go down, typically they'll go to a 500. Good luck in finding anybody in the country that'll do a 500.
So that's more investor part that's kind of giving you that.
It is, but good luck in finding somebody that'll do that. So most investors out there, if you've got a 550 credit score, they're going to require 10% down on FHA. Problem is, typically people that are in that 550 credit range don't have 10% to put down. So that can be, that's the issue there. But here's something else that you very, very unique to my company.
Yeah.
We do free credit repair.
Yes.
That's a big deal.
We're gonna definitely talk about that. It's huge.
Right. Because we've got a lady that's a credit expert and she's compensated at every closing.
Yeah.
So, us as a loan officer, we take less of a commission because obviously she gets paid for working on that credit for 6 months. Yeah. But it's a win-win because we want that person to get into a home.
Yeah.
They're excited because they're not spending, $199 a month on credit repair.
Yeah.
And we don't require any money up front. We just want their commitment that we can help them get to a closing.
And I'm not knocking credit repair companies in general, but sometimes
they get a bad rap.
Yeah, you don't know who you've hooked up with, and have they done something that's more on a permanent level of a repair versus a temporary level of repair.
Correct.
And the problem is, too many times we've seen something that's more temporary, and you think everything's good, and then all of a sudden you go to close and everything just showed back up.
Right, exactly.
And you're back almost to square one. So for them to be able to have something that's in-house and to be able to go, okay, we know, who we're working with, we know, their background, and they know how to take care of that stuff.
Exactly.
So
I mean, we could turn, a lot of times we're turning people around 60, 90 days.
Yeah.
And remember, we just need to get them up to a 580 or 600 or whatever. So if they're at a 530, 540, which we see a lot of, we can get 30, 40 points in 60 days, realistically.
And we've got somebody with them right now that we're trying to work on, it was a referral from a past client that Vicki and I had, and so we're definitely trying to see what we can do to kind of get them lined up quick and go from there. So
definitely.
So we talked about the 3.5% down and stuff, so we're good with that. So, we kind of mentioned a little bit about, do we really need perfect credit, to get approved? And we touched on it, again, you always want to try to do everything to get your credit score as high as you can. But again, the nice thing is knowing that you've got some, I guess I would call wiggle room. It's not you have to be at a certain level and that's the extent of it.
Correct. Yeah.
Stuff like that.
And again, FHA is just more lenient for credit scoring.
Yeah.
And there are things that even today, there's things that I get approved and I'm like, is this going to really work?
Sure.
And it works.
Yeah.
Yeah. And so as long as we run it through what's called an AUS, an automated underwriting system that taps in directly to Fannie Mae, Freddie Mac, and once we get that approval, we're golden.
Yeah.
So once we, as long as
nothing changes.
Yeah, exactly. Nothing changes.
There's the key.
You don't lose your job. You don't go buying a car.
And that's the other thing we've always talked about it. And like I say, Vicki and I talk about it every time, especially with newer buyers, in terms of saying, hey, pre-approval is not full approval and ending approval. So
correct.
Don't go do things. Don't go change anything. Once you get into the house, you've closed and everything like that.
Right.
Then that's the time where if you needed the couch or the different things you need for your home, that's when you do it, not prior to. Because, we don't need a new credit card or something else on it.
And people, we're very upfront with that because we really want to set the right expectation.
Because we don't want some at the end.
Right.
It's a problem.
Right. And a lot of these buyers, they don't know what they don't know.
Yeah.
And so it's our job to educate them, set the right expectation. And a pre-approval, I mean, I've had pre-approvals last a year.
Yeah.
I mean, they can, as long as your debt position stays about the same.
Nothing changes.
Your salary, nothing changes. And that same snapshot of when we approve is the real close snapshot of when, it works.
Yeah. Yep.
So all we're doing at that time, we're just updating pay stubs, updating bank statements. We've already got the pre-approval. Now we're just updating the file to keep it current.
Yeah, that's right. Because they're going to
credit
need to make
report's
sure
good for 90 days, so we're repulling credit, just make sure.
Yeah.
I've seen people really use a pre-approval from a year ago, and we're just updating.
Well, and that's why we've told folks there's nothing wrong with getting pre-approved.
Right.
The key becomes now you're ready to go because sometimes the right home for them hasn't shown up yet. And that's okay. But you also want to be ready.
Correct.
And not go, oh my gosh, the right home is here, and guess
Now
what?
what?
We still got to do something. And it's not that it takes Matt and his team that long to do it. It's more the concept of we can immediately be throwing offers in and stuff like that.
Correct.
We don't have to wait.
And you and I talk about this all the time. I'm a big fan of getting people pre-approved and getting that part of the process behind us. Because I can't tell you how often, it's the weekend, I'm trying to recharge my battery, I've been going at it all week, and the phones are blowing up. Hey, I got somebody that wants to make an offer. He's never talked to a lender, and it's go time. So,
quick.
It's got to go quick, and we need a pre-approval letter in yesterday. So it's like, so, we get that all the time. And I'm very appreciative of every opportunity, but the timing on some of those are just like, man, I would have loved to talk to this guy on Wednesday or Thursday and have this already teed up, and now you're putting in an offer like right now.
And you can only do stuff so fast. I mean,
exactly.
It's not that they're sitting around doing nothing. It's just
you're
not the only one. You're very important, but you're not the only one they're working with. So
exactly.
So another question that's come up a lot of times is, can you use gift money as a part of a down payment on an FHA loan and stuff like that? And so tell us a little bit about that concept in terms of gift money, so you can use that for it. Is there anything, special, sourcing, or what? Is there anything that necessarily has to be done for gift money? And can it come from anybody? Tell me a little more about that part.
So typically, a gift has to be from a family member.
Okay.
Now we've gotten gifts, and I'm like, is that really Aunt Betty?
Yeah.
But
they are that day.
No, but we don't do these genealogy studies and find out. I mean, if you say it's Aunt Betty, it's Aunt Betty. And so you and Aunt Betty fill out a gift letter.
Yeah.
Aunt Betty gifts you the money. We get a copy of your bank statement with the updated balance.
Yeah.
And then we get a copy of Aunt Betty's bank statement just showing it, because we need the source to make sure that the same person that signed the gift letter is the same person that actually sent the gift.
Okay. Yeah.
Okay. Now, on conventional loans, a lot of times Aunt Betty might say, I don't know Matt.
Yeah. Oh, yeah.
I'm not going to give him my bank statement.
Yeah.
Well, on a conventional loan, you can send that money, wire the money directly to the title company, and that's our sourcing.
Okay.
On an FHA loan, they don't
Okay,
let
so
you
you
do that.
do need to be able to have some kind of sourcing on that. And
Yep.
and it's nice because a lot of times that gift money can help with, money that you may not be able to fully, it does cost money to move into a home.
Right.
I've always thought, with the exception of VA loans, which is an earned no down payment concept.
Right.
I've always thought you got to have some, as we would call it, skin in the game. You got to be able to do that.
Right.
So I think it's good to have something. I'm glad it's lower amounts, the 3.5%, stuff like that. And it really gives somebody as a buyer an opportunity to say, okay, how bad do you want a home?
Yeah.
And you got to do something about,
Yeah.
it's not something that is owed to you or something like that.
Right.
If you want a home, work for it.
Right. And I can tell you, on most of the FHA loans we do, and I would say this would be the consensus across the board with my competitors as well. We see the 3.5% down, gift, maybe gifted, may not be gifted, but we typically, I bet 75, 80% of the time we see seller concessions.
Yeah.
So the goal is to try to get them in for just the down payment.
Yeah.
And, if you can work that in correctly, in the house. Now, and I will tell you, just a lot of times, we may need to bump the price of the house up $5,000 to give $7,000 in concessions.
And then we got to worry about appraisal.
That's the
other
only
key.
caveat.
Yeah.
Whatever we do,
Yeah.
it has to appraise. Because it has to appraise because we as a lender, we can only lend on the lesser of the purchase price or the appraised value.
Yeah, yeah.
It's the lesser of.
Yeah, and so that's where Vicki and I, if we're needing to do stuff where somebody's asking for some, closing cost assistance, if you will, seller contribution, that's one of the number one things we very quickly do is, okay, we're going to pull comps and go, if we do raise it some, and we usually don't try to ask for a lot. Maybe it's a $3,000 range or something that just kind of adds a little bit.
Right.
To where some money stays in a buyer's pocket in case they need, again, the moving stuff or the whatever. Keep it in your bank.
And hey, $3,000 to a lot of people is a lot of money.
Oh, it is.
And then by doing that, bumping the price up, that $3,000 over, trying to move the needle over 30 years, it's very insignificant.
Well,
and it's much more
360 months.
Exactly. So it's much more important for them to have the $3,000 on the day of closing versus their payment going up $15 a month or $20 a month, whatever that looks like. So depending on the interest rate. But no, it's a great strategy. We see it all the time.
Yeah, yeah. So talking about FHA homes and having to pass inspections and is that a problem? And I will tell you, just from our perspective, granted, we're fortunate that most of the things that come up on an inspection, I've certainly seen in all the years I've done it, but especially even Vicki now has seen so many of them where it becomes almost the same things in a lot of cases.
Right.
And we know whether or not something is a, nothing, more minor Home Depot fix or even a little bit more, or whether it's we need to go find a different home because it's a bigger problem. But, I haven't seen anything where FHA inspections cause an issue with the loan very much at all.
Right, and that was a big thing back when I got in business about, FHA was just such a harder loan to qualify for. If there was a little bit of rotten wood, if there was some, foliage growing on the roof, whatever. It hasn't been like that in many years, probably 20.
Yeah.
Seriously, I was only in the business a few years when that dynamic started changing.
Yep.
But I will tell you, no loan type requires an inspection. You don't have to get an inspection on conventional, FHA, or VA. They don't require an inspection. Now, VA, you have to do a termite report, WDI report.
Yeah.
If you're on a well and septic, we need to treat the water, but that's it.
Yeah.
And so just know that the appraiser, he's not an inspector. But if he walks through a house and he sees a crack going from the floor to the ceiling diagonally, he's going to note on there, hey, maybe some foundation issues.
Yeah.
So the only time we ever have to address anything is if that appraiser notes it. One appraiser may note one thing and next appraiser may not note anything. So it's, and there's been some things I've seen on an appraisal, I'm like, that should have been called out, and it wasn't. And we just kept moving forward.
Yeah, and the inspection is more for the,
it's the peace of mind.
The buyer's peace of mind, to be able to feel like, look, I'm not getting somebody else's cash cow or whatever you want to call it and have to go through that kind of stuff. So so kind of next on the list would probably be is there like a big misconception that you hear, or maybe even, buyers come to you with FHA? I know the biggest thing probably, again, goes back to down payment, I would think. That would be one of them.
Down payment's the biggest thing. And then also on FHA, you can only use an FHA loan for a primary residence. You can't do a second home or an investment property on FHA. It has to be primary. And then a lot of times people may have an FHA loan and they're wanting to get another FHA loan. You can't have two FHA loans unless you're meeting certain criteria. And one of the criteria is the second FHA loan has to be more than 100 miles away from your current. Good luck. That's very hard to do because people are usually staying in their own community. So that's been the problem. So if you've got an FHA loan and you're trying to qualify for two homes, it's a conventional. Or if you're a veteran, then it's a VA loan.
So, and we talked about, again, certainly starting this conversation with you as the lender as early as possible. That's one of the number one, the quickest questions we're going to ask a buyer that's coming to us is, are you pre-approved?
Correct.
And there's times when we might get, well, gosh, I don't want people to pull credit and all that. And to a point, we get that. Like, one of the number one things we tell them is, you don't want a bunch of people pulling credit. Of course you don't. But you want the right person who, ultimately would be doing the loan. They're going to have to do it no matter what.
Right. And you may not know this. I don't know if I've ever shared this with you, but I don't know how long ago, maybe a year and a half ago. But some new legislation's in place that once one lender pulls your credit,
they don't hit you.
Correct. They may hit you the first time, depending on where your credit score is, might go down 3 to 5 points. If you've got really bad credit, it might go down 10, 15 points.
Sure.
But once that first lender pulls your credit, you can have as many lenders pull your credit within 45 days.
Because they know you're shopping. Correct. Kind of like same thing as a car in a way.
And they're not going to penalize you. So that used to be a big thing, but now that's not a thing anymore.
And we still tell folks that, look, one of the pieces and the biggest reason why we're sending folks to him is, I mean, number one, he did our loan. He did one of my sister's loans. I think you did a refi on my dad or something. I'm trying to think of the list. And I mean, tons of people over the years.
Oh, yeah.
But the biggest reason, and it's with anything, whether it's a trade we work with or whatever, if you find somebody that's doing a good job, why am I changing? I mean, that kind of stuff.
It's not broke, don't fix it.
Yeah, that kind of stuff. And I think vice versa in terms of he knows what Vicki and I would do.
Oh, yeah.
And so that part is a very important piece, and it always sometimes baffles me because I know the internet is great for a lot of things.
Right.
It's great for these beautiful videos like we're doing right now. But you can't always believe everything on the internet. And so it's nice to have somebody that has done this long enough.
Yes.
And more importantly, if you come with a certain situation, Matt and his team are going to go, okay, well, let's figure out what's the best route to go and go from there.
Well, I can tell you, in my 25-year career, I've seen a lot.
Yeah.
And I've had my head handed to me plenty of times, and you only have to have those happen one time. So to say that my team and I have a lot of experience, we have a lot of experience.
Yeah,
we do.
Well, and the funniest thing that Vicki and I will always say is the number one person that worries me is the person that when we go, hey, have you gotten pre-approved? Oh, don't worry about that. We've got that covered. The high majority of the time, we can't even get them a loan, and yet they've told us, oh, don't worry about that part. We've got you covered. And it's like, that probably worries us more now than anything.
Right, exactly.
So it's one of those to where you just kind of go with the flow. And the thing is, for both of us, Matt's team and Vicki and I, our whole goal is, again, what's the best interest for somebody that is buying a home or selling in our case too. But because we have so many folks that really tell us almost every time we see them how much they actually love the home. Not just we got them into a home, we found them a home.
Right, exactly.
It's more that, how much that was the right home.
Right.
And so that kind of goes back into the don't play around with how long you want to get pre-approved or, want to start that process because sometimes that right home only comes around every so often.
Right.
And boy, you'd hate to lose it because of that reason.
Exactly. And I tell you, I don't know if I've ever told you this, but I mean, that's one of the things that I really respect about you and Vicki. You guys will, as long as it takes, till you find the right home. You're going to find the right home, because these buyers, I mean, this is a relationship that we want to have for the next 5, 10 years. You know, they're referring their family, their coworkers, their friends. I mean, you know, this is the relationship we want to have from start to finish. Your client is my client. So we're doing the same, we're adding the same value. And that's what we're trying to do. It's all about value.
And I think the bigger key is neither one of us are worried about the price of a home. So in other words, one particular client that we love, they're a good friend of ours and all that kind of stuff, and they're on the music side like I am too. But the home they bought was actually less than the homes we were showing them originally. So in other words, you know, I'm talking about a substantial difference, hundreds of thousands of dollars different. But it was the right home that they still love, and that's the more important thing. It's not about how much did you spend. It's does it fit your lifestyle? Does it fit your situation? Do you love it? That's the most important piece for what we're trying to do.
And you kind of know how a lot of people, I don't want to say, I kind of hate that term, keeping up with the Jones. But so many times I've qualified somebody for 400 or 450, and that's their max, and they want to go to their max. And a lot of times I'm trying to talk them down out of the tree. It's like, hey, let's not eat macaroni and cheese on the weekends. Let's get into the $350 price point, and now you've got another $500 or $600 a month to work with. And you know, because I want them to be happy, because I want to see them again in 5 to 7 years when they're moving. You know, I don't want, you know,
things are going to change.
It's not a transaction business for me. I mean, obviously we live, you know, it's how we feed our families is closed loans, but this is also a long, it's a long race for me.
Absolutely.
Just like it is for you.
So hopefully you've heard some good information on FHA loans, and if you're wondering whether an FHA loan is a right fit for you, reach out to us. We're going to have our details in the comments below. And also, if you've got any questions, please throw some questions in the comments. We are going to be doing more and more of these. I think next on the list we'll probably do conventional. We're going to go to FHA. We're going to go through each one of them. But again, the big key is, the goal is to help folks understand that when you're buying a home, and especially the loan process too, it's not, you know, it's not something to be scared of. It's actually easy. We're going to walk you through the whole process. And I think once people, especially if you've never bought a house, and when you walk through this whole process, you go, okay, that wasn't that bad. We don't draw blood. No DNA taken. Nothing like that. It's just, you know, we got to do it the right way and have a happy client at the end of the day.
And it's really not that much to do it. I mean, up front, the pre-approval process. I mean, we're getting bank statements, tax returns if you're self-employed, W-2s, pay stubs. I mean, there's only 4 or 5 things we need. And once we get those, I mean, we're turning around these pre-approvals in just a few hours.
Quick.
You know? So
thank you for doing this. Like I say, we're going to be back doing these again. Hope you had a good time watching this, and we will be doing more here soon. So like and subscribe to our channel, and we'll be back soon.